We're here in Hong Kong, one of the most important gateways between global capital and digital assets. Today, I'm joined by Laszlo Szabo, CEO and co-founder of Kiln, a company providing staking infrastructure for institutions. Kiln is also pivoting to on-chain finance for asset managers and, of course, for CoinShares. Let's get into it. Hi Laszlo, thank you for being with us. It's a great pleasure to meet you. Before talking about Kiln, could you introduce yourself and share a bit about your personal background?
Hi Jérémy, thanks for having me. So I started with hospitality school, so nothing related to tech, and then launched my first tech recruitment company 10 years ago, and was passionate about blockchain. I had a friend which explained me Bitcoin when I was in Hong Kong, actually 10 years ago, and then in Tokyo, and bought my first Bitcoin. I had another friend 8 years ago that explained me Ethereum. He was working at Consensus at the time, being really the only company building decentralized applications. And I decided to launch my first crypto startup after tech recruitment, still becoming a small shareholder in the tech recruitment company. And at the time, because the only job I knew was recruiting, I was putting CVs on chain on Ethereum. And then we pivoted quite a few times, launched our first infrastructure platform, and then staking in 2020. So here I am.
At that time, there were only a few protocols using staking. Could you envision proof of stake to be like that big that it is today?
Yeah. So first, if you want to understand proof of stake, you have to understand proof of work. Proof of work is this consensus mechanism that validates transaction on Bitcoin, where essentially proof of work, you have to buy chips, ASICs, usually specific hardware, spend a certain amount of electricity, and then find a nonce of the Bitcoin blockchain and get rewarded by Bitcoin in return. The security of Bitcoin is mainly focused on spending security, right? So the more you spend in security, the bigger of the hash rate percentage you have, and the more secure the Bitcoin blockchain is. The problem of that is it's not really energy efficient. That's one. It's not really scalable as well. If you take Bitcoin, only 15 transactions per second can pass, which is very far from Visa or other Web2 payments network. So proof of stake is this idea that you stake your native coins of a blockchain, let's say Ethereum, Solana, Cardano. And in return of that stake, in return of that collateral, in proportion, you get rewards from validating the transaction of the network. And this is much more efficient. You spend 99% less electricity. You can scale up to million TPS transaction per second. And that's why all the major new blockchains, apart from Bitcoin, are proof of stake.
Who are your customers?
So our customers are 200 customers across the three continents, Asia, Europe, and the US. So they are either platforms, exchanges, custodians, wallets. We also work with fintechs more and more, payments companies, general fintechs where you can buy stocks, but also crypto. And then we have a lot of funds as customers, asset managers.
When you created Kiln, you were basically not alone, but not far from being alone. Now the competition is wide. So how do you separate yourself from the competing platforms?
I mean, first of all, we came a little bit late in the staking space per se, because it's just in 2018, 2019, 2020, it was very retail driven. I understood that many companies around the world, exchanges at first in 2020, wanted to have white label validators. So this is how we started, a bit later than the others. But yeah, we were one of the few first to be enterprise first, right? Enterprise driven, with like the level of security, the level of reporting, the level of APIs, of automation. It's not the same thing to deploy a validator for a crypto degen that has a ledger and delegate to you than it is for essentially deploy for an exchange or an asset manager that asks for daily reporting, high performance, high level of security. We started not the first one, second wave, potentially one of the few first, and up to the leadership position.
How challenging is it to navigate between the different protocols? Like they work differently. There's slashing in Ethereum, there's no slashing in Solana, for instance. So how do you manage these differences?
Yeah, that's our job. So we at peak, I think we were running 88 protocols. So it's quite a lot. We reduced that because protocols are like startups, like they launch and then they are, for some, very successful. For major of them, they're not. So you should tell yourself, well, I mean, if there's no usage, if there's no users, if our customers are not interested about this protocol anymore, we should sunset it. But apart from this, yes, it's a daily, an hourly job, 24/7, 365 of great infra engineers to understand the specificity of each network. So Ethereum has slashing, Solana doesn't. Many other protocols, by the way, don't have slashing. So it's really about how do you make your validation key secure as the fund keys. Because if an attacker accesses your validation key, they can double spend, they can slash your validators. And if you have billions of assets, then it could be hundreds of millions of billions of assets that can be slashed. So yeah, all of that is part of our expertise.
How do you expect the staking market to become? Do you expect it to grow much more? What is your expectation related to staking?
Yeah, I think the staking market will always be needed, right? Like you will need staking and infrastructure in general to validate blockchain transactions. So you would need staking to validate transaction on Ethereum, and Ethereum is not going away. And to validate stablecoins, real-world assets are happening on Ethereum. So I think in that sense, it's going to be needed. It's still going to be essential. But then I don't see the staking market booming from there. It's really tied, first of all, to the asset price. If Ethereum goes 10x, then of course the staking market will be impacted positively because you staked your ETH and the staked assets grows in values. But I don't see the staking market booming from there. Whereas I think what's going to really increase is the transactions that are being validated on Ethereum, right? So stablecoin, real-world assets, the true economy. So I think staking will always be there, but what will grow faster is DeFi.
So that means, as a company, you need to adapt yourself. You're 6 years old, basically. That means you're quite resilient in the crypto market. So does that mean that you're abandoning staking for another sector?
I think resilience is an important word first. In crypto, you have to be there long enough to experience success. And it's going to be ups and downs. Markets are ups and downs. You're going to have potentially security issues. You're going to have market issues. So navigating through the storm on a regular basis is really how you get to a successful outcome in crypto. So yes, you have to adapt. It's one of the fastest, if not the fastest industry in the world, right? Everything is open, smart contracts are open. So innovation happens really, really fast. The adaptation in the yield section for us started with staking, then liquid staking came, which is like kind of the first product in DeFi, right? You tokenize your staking assets and you make it liquid in DeFi. And then everything else, lending and now tokenized assets, so the real world coming on-chain finally, after all these years of narrative, is finally coming to a true end. So I think this is our adaptation. Our customers, they want to be exposed more and more to stablecoin yields, right? Stablecoin, as opposed to the staking market, is doubling year on year, and still 90% of stablecoin are not earning yield. So there's a massive potential growth there. And then the other observation is that DeFi is becoming more and more real world, right? With real world assets, money market fund, private credit fund, tokenized private equity ventures that will carry a yield. So our adaptation was to understand that world and bring the right products so that we could bring a stablecoin and real-world asset yield to the world.
So let's name the elephant in the room. You announced in November 2025, Railnet. What is Railnet?
So Railnet is essentially the observation of what I mentioned. So stablecoins are growing really, really fast. Our customers, when it comes to Bitcoin and ETH, are asking for higher yields, not only the staking yields. And we saw the vault space in DeFi growing fast. What's a vault? It's an on-chain fund where you can manage the client money still in a non-custodial manner. So the asset manager that is managing this vault doesn't have access to the fund. So it's a very elegant way to manage money of a customer because it's fully transparent, it's non-custodial. The thing with vaults is that they were very lending driven. So DeFi is synchronous by essence. You can go in and out in a liquid way, and that's what customers are expecting, right? They don't expect their assets to be locked in DeFi. But these vaults, 4626, 7540, so standards in the vault space, were really not meant to wrap DeFi, synchronous, go in and out, lending, for example, and real-world assets together. And the specificity with real-world assets is because they are in the real world, they always have constraints like redemption times, right? The money market fund has a T+1 or T+2 settlements. They're unliquid for 1 or 2 days off chain. Or a periodic credit fund is unliquid for 30 days off chain. So what Railnet does, it standardizes the way DeFi protocols and real-world assets are read on-chain with state machine. I hope this is not too complex, but we inject redemption times, we inject KYC information, we inject every information that could be happening in the real world into these smart contracts. So that when an asset manager come and manage a Railnet vault, if you will, they can, first of all, very easy interact with any DeFi protocols or assets, underlying assets, without really understanding the logic of this technical logic of a protocol and assets. They can only focus on manage the risk, right? Do what they do best. For a user or a platform or regulator, they can see what's happening in real time on chain. Oh, CoinShares has put it, part of my money into Aave, into Morpho, into Compound, into Uniswap LP's position, but also into BitL or into ACRED. And in the case of BitL and ACRED, there is 1 or 2 days or 30 days redemption times. So there's part of illiquidity there that CoinShares has to manage on chain. So that's what Railnet is. It's an ecosystem that standardizes the way DeFi and real-world assets are interpreted on chain. And the first product we launch is an on-chain fund, a vault for asset managers, and many other products coming along the way.
So what kind of asset managers are working with you?
So, tier 1 asset managers. In DeFi, you have a lot of, for us, it's asset managers, but they call themselves curators. And I think it's a very good analogy that curators are most of the time not super professional or doesn't carry all the traditional financial experience of managing clients' money. I think what's going to happen is you're going to have tier 1 asset managers like CoinShares that have years of understanding crypto and years of managing clients' money off-chain and would start to do it off-chain. So we really are quite picky on the asset manager we work with, because ultimately the risk in DeFi is still high, and you need to make sure that you really trust this counterpart that is the asset manager. So in the case of CoinShares, to us, they are one of the best, if not the best, asset management company in crypto for years. They have such an experience. They have a great team. I'm also, of course, very close to Jérôme, Jean-Marie, all the ones powering the products and the strategies on these vaults. So yeah, very, very excited to collaborate with the CoinShares team.
And to be clear, we are really happy to be on chain with you. Thanks to Kiln. Thank you for that. What kind of growth this time do you expect for this market, for the vault market?
So we have a lot of demand on 3 assets, as I said: Bitcoin, Ethereum, stablecoins. Bitcoin, well, there's no great yield in Bitcoin right now, right? You had at some point Bitcoin staking, Babylon, but it's kind of drying up because this concept of restaking is a little bit fading away. It's same for Eigenlayer on Ethereum. So there's a lot of demand of taking a Bitcoin, put it at work in DeFi or into a real-world asset and loop it, or put it even like in DeFi and stocks, whatever product you can think of. But you essentially bridge that Bitcoin usually into an EVM type of environment for now. But at least it carries you from 4 to 6% yield on Bitcoin, which is by far significant and really, really better than what you can find in the market today. So that's Bitcoin. Ethereum, same staking yield is at 2.8%. Now it was a boosted staking yield with Lido V3 or essentially putting Ethereum in DeFi. You can go up to 5-6% type of yield. So also very interesting, sometimes 2 times what you can find in the staking yield. So a lot of our customers came to us for staking and they're like, well, I want to put part of my portfolio into these higher type of risk, but potentially higher type of rewards, also type of strategies that is managed by great asset managers like CoinShares. And the last one, of course, is stablecoin. Stablecoin market, really, really big. Only 10% of stablecoins are yielding. You have all the crypto companies, exchanges, custodians, wallets. They have a lot of stablecoins on the platform. They're not offering stablecoin yields to their customers, or they started to offer lending, but now they will offer DeFi and real assets in the same product. And of course, the fintechs. So you can think of payment companies. Payment companies, they will use stablecoin to go in and out, A to B, regardless of where they are in the world, in a very efficient way. And then they will put the float at work. So you are a user in emerging markets, in other countries in the world, you receive stablecoin on your wallet, and you will have a little toggle say, well, I want to earn, right? So when I receive, I yield. When I send, I unstake and I send, and the receiver yields as well. So this is the market we're going to be in, and these yields will come from great asset managers in the background.
How does that affect your own business model? Would you mind sharing the revenues that you expect from this new market?
So we think that the revenues is going to be majority of our revenue for sure. We think it's going to be a majority of our business in the next 2 or 3 or 5 years. We think the asset management revenue is not the only type of business model we can get because Railnet essentially is built in a way that we will move real-world assets that by essence are on liquid off-chain in a more liquid way on-chain through the standards. So we could think of potentially tomorrow having spot or derivatives market on top of Railnet. But yeah, we think this will represent by far a very large majority of our revenue in the coming years.
So Kiln is 6 years old. How do you see Kiln in 5 years?
Well, Kiln was the staking company. Railnet is the decentralized ecosystem that powers DeFi and real-world asset together. So yeah, in 5-6 years, I hope Railnet become the default standards for this capital to move on chain. And I hope we continue to collaborate with amazing asset managers like CoinShares.
Thank you, Laszlo.
Thank you very much for having me.